Hey traders, welcome back to another video at the Modern Day Trader with your boy Marcy. And we got a good one today. We got a good one. So last week when we came to the markets and we analyzed the markets, we were looking for anticipated sell-offs from an area of from premium areas or equilibrium. Now, the reason why I'm on the daily today is just to demonstrate how liquidity actually works and how structure within structure works. So what that essentially means is you might have structure on the daily time frame, but then on the 4 hour time frame, we might be shifting, or it seems like we're shifting structure on the 4H. But what that could be is liquidity grabs above certain areas, right? So essentially, what you can see on the daily time frame that I pointed out last week was that we have these areas right here, which are our trading range. We have the swing high and we have the swing low. And this right here would be our trading range for the daily time frame. Now, if I was to place a fib on this daily time frame, which I had on last week, you could see that last week when we were trading, when we came to the charts, we were in and around here. So this was our Sunday or Friday close. So we were in these areas. Now, my whole anticipation was to see price action short to the downside after coming in to taking these highs from a 4H perspective. Let me show you. And I left on this last liquidity grab right here. My whole anticipation was that price action should first push to the upside and then after pushing to the upside to see that push to the downside. Now, what you can see is that you could have found a perfect entry using fair value gaps. What is fair value gaps? Now, my understanding of fair value gaps, which is, let me give you a bit of a disclaimer, it is very minimal at the current moment. I'm still trying to understand the whole fair value gap, inefficiency in price, order blocks, liquidity, and all of those things. But my understanding of fair value gaps is essentially when price has an impulsive push to the upside or to the downside, and it leaves behind candles or multiple candles where there is inefficient or unhealthy price action, which essentially means that no wick or at no given time did price when it moved up, did it pull back to fill these areas right here. So what that essentially means is that in this price action here, you can see that we pushed up to the upside. No wick filled this particular candle on Tuesday at 4 o'clock, at 2 o'clock South African Standard Time. And then we had another impulsive push to the upside, and no wick came into this candle either. So we had this fair value gap that printed right here, which is essentially unhealthy price action. Because at that given time, there were pure buyers in the market, and the buyers pushed the market up so much that the sellers didn't actually come down to essentially create a healthy price action. And that is my understanding of what a fair value gap is. And then what you can see is that when price action came played out on Wednesday into from Tuesday into Wednesday, we had these Asian highs, Asian lows, and with that, you had this fair value gap as extra confluence. Now, if I was to drop down to the 15-minute real quick, you can see that with this Asian low that was created around 345, we also had this order block, which is something that I call a smart money trap, which I got from our car. So essentially, we had this impulsive push on the 15-minute. You can see that we are making higher highs, higher lows. Impulsive push. We have this order block or smart money trap right here. And the reason why I'm considering it a smart money trap is because I'm anticipating that this liquidity could be grabbed and we could run this liquidity to then see the potential upside on this trade. Now, how do I add confluence to this being a potential liquidity grab and not having price bounce out of this area? It's because of this fair value gap below here, the 1H order block that we have below here. And what you can see is the price action on Tuesday in London session actually came into this, had a mini reaction, broke structure, essentially enticing lower time frame buyers to start buying, and then we swept everything. The smart money trap, that's why you can see SMC, this was a 1 minute smart money trap, swept this, and I swear down this wick was a 1 minute candle that pushed to the downside and then went to the upside. Let me show you. So if I go to Wednesday, we had a 1 minute wick to the downside, and then what do you see? Price action starts pushing up. and then you see price action pulling back, creating this swing low, and boom, we start pushing to the upside. Now, how would I have entered this? So with 1 minute entries for this particular strategy, what I've been testing so far is that when you see price action on a higher time frame collect liquidity like the 15-minute time frame. So we collected this Asian low liquidity, and then we swept this 1 or 15 minute smart money tap order block. When we create this break of structure, what I usually do is I'll mark the last known low before the impulsive push to the upside, or the last known high before the impulsive push, bearish candle or bullish candle before the push to the downside. And then I'll wait for it to be essentially not invalidated, but for a candle to push all the way below that to collect these stop losses here, because a lot of people are entering with buys above these areas here. So they're entering with buy limits there, and they're putting their stop there based on or 1H order blocks or based on ICT concepts, right? And then what do you see more often than not? You'll see the sweep of that liquidity on the 1 minute. So we get the sweep of that liquidity, we tap into that fair value gap, and then you can start to see, oh, price is continuing. Now, usually, this is the way I would enter this, and this is what I've been testing, is that after we get the sweep, if we have if this candle's low wasn't as long as this was, so that's 34 candles, what I'll usually do is if we get an inside candle in this, I'll put my stop at the candle that creates the inside candle's low. So then that would have been 12.7 pips. You add a pip to that, so make it 14 pips, and then you can start targeting Asian highs. This was London highs liquidity right there. So you could have targeted that for 1 to 3.8, and then target Asian highs with partials at this 1.3 level right there, right? And you could have seen that we would have gotten taken out to break even, but you would have gotten your partials off the table and you would have banked a 1.5% already. So that's the way I look at the market, and that's what I'm testing. It's not necessarily pure ICT concepts. I'm leaning on the fact that I can learn liquidity, I can see liquidity pools, and then when I get down to the 1 minute time frame to enter, I'm looking for smart money traps where price action could potentially grab liquidity and then push in the opposite direction or in the direction that you're anticipating from a higher time frame perspective. Now, with that being said, last week we kind of anticipated that price was going to push all the way into these 4H highs and equilibrium, and that's why I feel like you could have taken these longs. Now, a lot of people who saw this fair value gap, including Sam, took the trade off from the fair value gap with their stops below the fair value gap, and then you just anticipate the price actions and they go higher. Now, what I wanted to mention, what I didn't necessarily look at last week, was these fair value gaps on the 1H, on the daily, sorry. So you can see that in between that, this bullish candle and this bearish candle right here, there's no full of this price action that we have here. So we created this fair value gap. And I'm anticipating that now, since we are in premium pricing, there's a high chance that a sell-off could come with this fair value gap that we have right here. Now, obviously, we could still push into this order block, but I've found testing that like a huge amount of orders actually tap into the fair value gap and then start shifting structure. So whilst I know that there's an order block above here, I'll be keeping an eye on 1H structure in this fair value gap. So there is still a little bit of space for us to push up early in the week, and then we can start anticipating that price action could push down. Now, as always, let's add the COT report. What you can see is that the Japanese yen net positions are still hugely long with 177,814 contracts to the upside. Net change is still bullish. This is a bit concerning though, that the British pound is actually changing bullish again. It was getting lower and lower and lower, closer to that zero net position. But right now we are actually sitting on 20,490 contracts with a net change of 13,981 net change of long contracts. So that's very interesting. I think we might potentially see a mini range going into early in the week in that fair value gap, which is actually something that I would want. Potentially an Asian range in this fair value gap, potentially an Asian range with a spike to the upside, and then you see the change of structure possibly a midweek reversal, which I'm hoping for, or even an early reversal. And then you could then start anticipating the price action could potentially push to the downside. Now, how do we know that our whole bearish bias is invalidated? Is if price action breaks above these 195, 962 areas. And that's what I'm going to be trading from a higher time frame perspective. I'm going to be looking for prices to push to the downside. Now, I'm not going to be looking for buys no more. Just because I feel like now we are in premium levels. It's not like we were trading here where we were essentially in, I would say, some type of discount under equilibrium. So, like, what I'm anticipating now is that once price action does get into these levels here, that we're going to start seeing these sell side or sell buyers coming back into the market with huge impulses to the downside. And that's what we're hoping for. So, guys, remember that you need to stay safe in the markets, use risk management, and use appropriate position sizing. So, without further ado, guys, don't forget that your unmatched perspicacity coupled with your sheer indefatigability makes you a feared opponent in any realm of human endeavor. From your boy Marcy at the Modern Day Trader. Have a profitable week. Have a good one. Stay consistent. Stay disciplined. And peace out, man.